First, let's now move on to the markets. Analysts have had a week or two to digest the Q3 earnings reports from most banks. How have the numbers impacted the fair value of bank stocks? Joining me now to review that sector is Muyiwa Oni, a banking sector analyst at Stanbic IBTC. Thank you so much, Muyiwa, for joining us. So the story of the market has been, yes, we've seen those numbers and they've been pretty mixed. I'm sure you have your thoughts on which stocks have outperformed in terms of their earnings. But let's get, first of all, your thoughts on the overall story that these Q3 numbers tell us about the banking sector.
The results have been mixed, like you said, and I would say you wouldn't necessarily see any major themes per se, apart from interest income, I would say, which seems to have declined, and it's clear that the CRR or public sector funds had a strong impact on that decline in interest income, and the non-interest revenues as well. For the sector, we saw a decline in that, and I would say we didn't find this trend surprising because we had highlighted that in previous notes and done some analysis on that as well, and even revised some of our earnings estimates to reflect those expectations. So I would say in general we weren't really surprised by the overall performance of banks. So the weaknesses we saw didn't really come out as a surprise. But I would say one trend that came out that was a surprise, I would say, was cost of funds, which I would say on the whole, there seemed to have been a decline in cost of funds for the banks within our coverage, even though a few banks saw increase in cost of funding. So if you look at Fidelity, FCMB and Diamond, we saw increase in cost of funding for these three banks. But I would say overall there was a decline in cost of funds, which was surprising more because of the hike in interbank rates in September, and so we were actually expecting that to have a negative impact on cost of funding for banks, but that wasn't the case. And speaking to the banks and reviewing the results as well, was clear that the overall strategy to reduce term deposits in the deposit mix was a clear driver for that, and I would say that was a clear positive trend from the results. Loan growth, deposit growth for the quarter also wasn't, so a few banks stood out as well. We saw positive deposit growth in UBA and in FCMB as well, but I would say overall deposit growth seemed to have been slightly muted for the banks. Loan growth, on the other hand, was positive. So apart from Skybank, where we saw a 4% decline in loan growth, overall there was strong Q3 loan growth, and it was clear that the power sector divestment, so banks obviously participated in that. I would expect that to have been a key driver. Speaking of a few banks, that was a key driver, and also the loans to Dangote refinery as well seemed to be one strong driver of loan growth for banks during the quarter.
Let's stay on that theme around loan growth, and the power sector clearly has been something that has contributed to the growth we've seen recently, but how risky would you rate investments in that space for the banks? Clearly it seems like the next big opportunity with respect to financing deals in Nigeria, but then again, we know that the power reforms haven't been perfect. There are a few risks that a few people have highlighted. What's your overall assessment of the risk of banks getting into that space?
I'd say that's still a very, very big question, and I'd say we still seem to be looking for answers to that. And I'd say for now, because of the low level of investment in that sector, the risks seem to be limited, but obviously there were concerns around liabilities linked to the assets, and also potential, should I say, valuation as well. Not sure how much due diligence have been made on the side of the buyers as well. And so for me, I think trying to understand drivers of that obviously would help to highlight or bring to fore what the risks are. But I would say for now, because investment is still clearly needed in that sector, level of generation in power generation in Nigeria is still quite low. And if you notice, most of the banks that we've spoken to seem to be far more comfortable with lending to the distributors, really, because of the cash flows from distribution, and so for them they seem to be quite more comfortable with that, and also because most of them have also been receiving agents for the power company before the divestment, and so they have an idea of what the cash flow looks like for the various distribution companies, and
right.
so based on that, I would say they were able to pick and also assess and do some assessment in terms of risk.
Meanwhile,
I would say for now that
bit...
seems to be a very big question.
All right, let's move on to valuations and how have these numbers impacted your ratings of stocks across the board? Tier 1 banks, Tier 2 banks, what has changed for you?
So for the interim for the Q3 numbers, nothing seems to have changed in our view, and the reason why was because we already reviewed our estimates after the H1 numbers, and so these numbers came in broadly in line with the expectations. We downgraded our earnings expectation for Zenith Bank for 2013, and it was really more because management came up with a much more bearish estimate or outlook for the year versus what management was looking out for in H1. And so even though we were far more conservative than management's guidance, but management downgraded their outlook further, and so we revised our estimates on that. But based on that, we still maintain our target prices. And even in terms of valuations as well, it's clear that the market still sees that you're better off staying in the quality names. So you see the likes of GT Bank, Zenith trading at a premium to the market,
right,
while the likes of Fidelity, FCMB, Sky are still trading at discounts. And it's really reflecting
right,
the regulatory headwinds and the reality that we'll see a far more stronger impact
okay,
on the Tier 2 banks than the Tier 1 banks.